uncomfortable truth. Most traders aren't losing because charts are hard. They're losing because they're looking at the wrong things. Once you see what smart money actually leaves behind on a chart, you can't unsee it. In the next few minutes, you'll learn advanced chart reading techniques that expose real momentum, trap zones, and high probability entries, so you stop guessing and start reading the market like a pro. Miss this and you'll keep trading one step behind everyone else. The tape never lies. Men lie, opinions lie, but the chart, if you know how to read it, tells the truth in plain sight. Most fellows stare at charts the way a tourist stares at a foreign newspaper. They see the lines, they see the candles, but they do not understand the language, and then they wonder why the market takes their money as calmly as a tax collector. Have you ever felt that sting? Thought you saw the move, only to watch price turn the other way. I learned early that the market does not reward activity. It rewards understanding. Advanced chart reading is not about drawing more lines than the next man. It is about seeing what the crowd cannot see, and more importantly, what the crowd refuses to see. You must understand something right now. Price does not move randomly. It moves because money moves. Large money, patient money, informed money. The chart is simply the footprint of that money walking across the market floor. If you learn to read those footprints, you stop guessing. And tell me, how many traders are still guessing every single day? The average trader looks for patterns the way a child looks for shapes in the clouds. Head and shoulders here, double top there, but the professional, the man who survives, studies behavior. He studies how price arrives at a level. He studies how it leaves. That is where the real story lies. When I look at a chart, the first thing I ask is simple: who is in control here? Is demand stepping in with confidence? Or is supply quietly leaning on the market? You see, the battle between buyers and sellers leaves clues. The problem is not that the clues are hidden. The problem is most traders are too impatient to notice them. Patience. Now there is a word most speculators dislike. Yet without it, chart reading becomes nothing more than decorated gambling. You cannot rush understanding any more than you can rush the market. Have you noticed how the best moves often come after long periods of quiet? There is a reason for that. Accumulation and distribution. These are the market's breathing patterns. Smart money builds positions slowly, quietly, without excitement. The crowd, on the other hand, prefers noise. It prefers fast candles and dramatic breakouts. But by the time the move looks obvious, who do you suppose is already positioned? Advanced chart reading begins when you stop reacting to price and start interpreting intention. A breakout is not bullish just because it moves up. A support level is not strong just because price touched it before. You must ask what happened at the level. Was there urgency? Was there hesitation? Was there absorption? Let me put it plainly. Strong moves leave clean footprints. Weak moves leave messy ones. Once you train your eye to see the difference, the chart begins to speak in a much clearer voice. And when that happens, your trading decisions become calmer, almost boring. Have you ever noticed how the best trades rarely feel exciting at the entry? Another mistake the public makes is believing more indicators create more certainty. I have seen traders bury a chart under so many colored lines it looks like a holiday decoration. But the market does not reward decoration. It rewards clarity. Price and volume, properly understood, will tell you more than a dozen lagging tools. Now, do not misunderstand me. Advanced chart reading is not about predicting every tick. No man alive can do that consistently. The goal is far more practical: to put the odds slightly in your favor, and then manage risk like a professional. That is how fortunes are built in speculation. Not through brilliance, but through discipline repeated over time. Your mindset matters here more than you may think. If you come to the chart looking for excitement, the market will gladly give you expensive lessons. If you come looking for confirmation of your opinions, the market will humble you quickly. But if you come as an observer, calm, patient, and a little skeptical, the chart will begin to reveal its habits. Habits, that is the right word. Markets, like people, have tendencies. They repeat behaviors under similar conditions. Advanced chart reading is simply the study of those recurring behaviors. Not perfectly, not mechanically, but consistently enough to build an edge. And tell me, isn't that all a serious trader really needs? Risk must always sit beside your chart work. I never trusted a man who talked only about entries and never about exits. The chart may suggest opportunity, but your position size and your stop determine survival. Wealth in trading does not come from being right all the time. It comes from staying solvent long enough for your edge to play out. You must also learn to sit still. This is harder than it sounds. The market pays the patient observer and taxes the restless participant. Many traders lose not because they cannot read a chart, but because they cannot wait for the chart to align with their plan. Have you ever taken a trade simply because you were tired of watching? That impulse is expensive. When you truly begin to read charts at an advanced level, something subtle changes inside you. You stop feeling the need to chase every move. You become selective, almost stubborn. You begin to understand that missing a trade costs nothing, but forcing a bad one can cost dearly. And there is one particular behavior on charts, one that smart money leaves behind again and again, that most traders completely overlook. Strong trends show commitment, weak moves show hesitation. And if you cannot tell the difference, the market will teach you the expensive way. You see, price movement is never just movement. It is behavior. It is intention made visible. When a market truly wants to move higher, it does not creep forward like a man unsure of his footing. It advances with purpose. Candles push cleanly. Pullbacks are shallow. Buyers step in quickly, almost impatiently. Have you ever watched a chart and felt the move looked almost effortless? That is commitment. A strong trend has rhythm. It breathes in and out, but it keeps walking in the same direction. The corrections do not look violent. They look controlled. Price respects structure. Support levels hold without drama. Volume often expands in the direction of the trend and dries up on the pullbacks. These are not accidents. They are footprints of confident money at work. Now compare that to weak movement. Weak moves are noisy. They stall. They spike and then immediately retreat. You will often see long wicks, choppy candles, and hesitation around key levels. The market looks like it cannot quite make up its mind. And yet, many traders, especially the eager ones, mistake motion for strength. They see price moving and assume opportunity is knocking. Have you ever chased a breakout that looked good for 5 minutes and then completely fell apart? That is hesitation revealing itself. The market often tests traders through these weak structures. It tempts the impatient. It rewards the observant. A weak trend usually shows one or more warning signs: deep pullbacks, overlapping candles, failure to follow through after breakouts, or volume that does not confirm the move. None of these alone guarantees failure, but together they paint a picture. And advanced chart readers learn to read pictures, not just patterns. Commitment in price often comes from higher time frame participation. Larger players do not move in and out every few minutes. When they step in, they tend to defend their positions. That is why strong trends often show consistent higher highs and higher lows, or the opposite in downtrends. The structure holds because real money has a reason to be there. Weak moves, on the other hand, are often driven by short-term traders and emotional reactions. They lack sponsorship. They lack follow-through. The chart begins to look tired even while it is still moving. And if you train your eye properly, you can often feel that weakness before the crowd notices it. This is where patience becomes a technical skill, not just a virtue. The disciplined trader waits for proof of commitment. He watches how price behaves after the breakout. Does it hold above the level? Does it attract continuation? Or does it immediately struggle? The difference between those two outcomes is often the difference between a professional trade and an expensive lesson. Many traders focus too much on the entry candle and not enough on what happens next. But the market always reveals its strength, or its doubt, in the follow-through. Strong trends expand. Weak moves hesitate. Strong trends make traders uncomfortable because they feel too obvious once they are underway. Weak moves lure traders in early with excitement and then quietly reverse. If you begin to study charts with this lens, not asking, is it moving? But asking, is it committed? You will notice your trade selection becoming more selective, more deliberate, and far less emotional. And there is a subtle behavior that often appears just before a strong trend reveals its true commitment. Price is the final truth. Learn to read what it actually did, not what you hoped it would do. Most traders come to the market carrying opinions the way a man carries baggage. They read the news. They listen to forecasts. They form a bias. And then, without realizing it, they begin searching the chart for proof that they are right. Tell me honestly, have you ever looked at a chart and seen exactly what you wanted to see? That habit is expensive. The market does not pay for opinions. It pays for accuracy. And price, in its quiet way, records the only vote that matters: money committed. Every candle on your chart represents a decision made with real risk. That is why I learned long ago to respect price above all commentary. When you study advanced chart reading, your first task is not prediction. It is observation. What did price actually do at that level? Did buyers step in with urgency, or did the move stall and wobble? Did the breakout hold, or did it collapse back into the range? These are not philosophical questions. They are measurable behaviors. Many traders fall into the dangerous habit of arguing with the chart. Price breaks down, and they say it is manipulation. Price trends higher, and they insist it is overextended. But the market does not care about being right or wrong. It only reflects the balance of buying and selling pressure in that moment. If price is rising steadily, someone with size is accumulating. If price keeps failing at a level, supply is present whether you like it or not. Your job is not to debate the market. Your job is to read it clearly. Advanced chart readers develop a kind of humility toward price. They do not marry their bias. They do not defend their predictions. They watch. They interpret. They adjust. Have you noticed how the traders who struggle the most are often the ones most emotionally attached to their analysis? There is a reason for that. Hope is not a trading strategy. Neither is stubbornness. Price will move where it must move, and the sooner you accept that, the faster your chart reading improves. When I look at a chart, I am not asking what should happen. I am asking what is happening. That small shift in thinking separates speculation from professional trading. Another thing worth understanding: price often tells the truth before the news does. Markets anticipate. They lean. They reposition quietly before headlines catch up. If you rely only on outside opinions, you will often find yourself reacting late. But if you train your eye to read price behavior, the speed of moves, the quality of pullbacks, the reaction at key levels, you begin to see the story unfold in real time. This does not mean price is always clean or easy to interpret. Far from it. The market is designed to confuse the majority. There will be false moves. There will be traps. But even traps leave evidence if you know where to look. For example, when a breakout fails quickly and price snaps back into the range, that is information. When support breaks with expanding momentum and no meaningful defense, that is information. The chart is constantly speaking. Most traders simply are not listening carefully enough. Clarity in chart reading comes from focusing on behavior, not decoration. Strip away the noise. Watch how price moves from level to level. Watch how it behaves when it gets there. Does it accelerate? Does it hesitate? Does it reject sharply? These observations build your edge slowly, almost quietly. There is nothing glamorous about it. No flashing signals. No magic indicators. Just disciplined attention to what the market has already revealed. Over time, you will notice something change in your decision-making. You will feel less urge to predict and more comfort in waiting for confirmation. You will become less impressed by dramatic candles and more interested in what happens immediately after them. Because the truth of the market is never in what traders hope, but in what price has already proven. Volume is the market's voice. Silence at key levels often means trouble. Price may show you where the market moved, but volume tells you how much conviction stood behind that move. Many traders watch price alone and wonder why the story keeps surprising them, but the experienced operator knows that movement without participation is like applause in an empty room. It looks impressive for a moment, until you realize no one serious is involved. Have you ever seen price break a level cleanly, only to drift back as if nothing happened? That is often the sound of weak volume. You must understand something simple but powerful. Strong moves usually attract strong participation. When real money steps into the market, it leaves weight behind. You will often see expanding volume as price pushes with purpose, not always explosive, but clearly present. It is the difference between a crowd walking and a crowd marching. Now consider the opposite. Price reaches an important support or resistance level, but volume dries up. The candles become thin. The follow-through feels lazy. That quietness is not always peaceful. Sometimes it is dangerous. It often means the market lacks commitment at the very moment it needs it most. And this is where many traders get trapped. They see the level. They see the breakout. They enter quickly. But they fail to ask the important question: who is actually participating in this move? If volume does not confirm the action, the breakout may be standing on weak legs. Have you ever taken a trade that looked perfect technically, but somehow never gained momentum? Volume was probably whispering a warning you did not hear. In advanced chart reading, you are not just looking for high volume everywhere. Context matters. Rising volume during a clean trend often signals healthy participation. But rising volume during choppy, sideways movement can signal conflict, heavy buying meeting heavy selling with no clear winner. Likewise, declining volume during a pullback in a strong trend can actually be constructive. It suggests the counter move lacks conviction. Sellers are present, yes, but not aggressive. This is the kind of subtle distinction that separates surface-level chart readers from professionals who truly listen to the market's tone. Volume also reveals something else the public often misses: absorption. When price repeatedly hits a level on heavy volume but fails to break through, someone with size is quietly taking the other side. That is not random noise. That is business being conducted. And if you train your eye to spot it, you begin to see where the real battles are happening. But remember, volume is a guide, not a guarantee. There will be times when it misleads the careless observer. News events, thin sessions, and algorithmic activity can distort the picture. That is why volume must always be read alongside price structure, not in isolation. The skilled trader listens for harmony between the two. Strong price movement supported by healthy volume often deserves respect. Weak price movement on fading participation deserves skepticism. The chart is not shouting at you. It is speaking in tones. Your job is to become sensitive enough to hear the difference. Patience plays a role here as well. Volume often reveals its meaning over several candles, not just one. The impatient trader reacts instantly. The disciplined trader watches the sequence. He asks, is participation increasing as the move develops? Or is the market quietly losing interest? Because when the market loses interest at a critical level, the next move is rarely gentle. The best breakouts usually look boring at first glance. That statement surprises many traders, especially the ones who came to the market looking for excitement. They expect the big move to announce itself with fireworks, huge candles, explosive volume, and a feeling of urgency in the air. But the market, in its quiet wisdom, rarely rewards what looks obvious to the crowd. Have you noticed how the most dramatic breakouts often come after the move is already well underway? There is a reason for that. Professional money does not like attention. Large positions cannot be built efficiently in chaos. They require time. They require calm conditions. That is why many of the strongest breakouts begin in periods that feel almost dull. Price tightens. Volatility contracts. The chart looks sleepy enough to bore the impatient trader into looking elsewhere. And that impatience is exactly what creates opportunity. When a market is preparing for a meaningful move, it often goes through a phase of quiet compression. Candles become smaller. Ranges narrow. Price respects boundaries more cleanly. Nothing about it feels urgent. In fact, many traders mistake this phase for weakness or lack of opportunity. Tell me, how many times have you ignored a chart because it looked like nothing was happening? Meanwhile, the market was getting ready. Strong breakouts tend to emerge from this kind of orderly structure. When price finally pushes beyond the range, the move often looks almost too clean at first. Not explosive, just decisive. The early candles may not be dramatic. They simply hold above the level without immediately collapsing back. This quiet follow-through is often more meaningful than a single large spike. Weak breakouts, on the other hand, love drama. They burst through levels with oversized candles that attract attention quickly. Social media lights up. Retail traders rush in. But when you look closely, the structure underneath is often messy. Follow-through fades. Price wobbles. The move struggles to maintain altitude. Excitement was present, but commitment was not. Have you ever chased one of those beautiful, looking breakouts that lost its strength almost immediately? That is the difference between noise and intent. Advanced chart readers learn to respect the quiet strength of orderly movement. They look for breakouts that hold their ground rather than scream for attention. They watch how price behaves after the level is cleared. Does it consolidate calmly above resistance? Does it show controlled pullbacks instead of violent reversals? These small behaviors tell a larger story. Another subtle clue lies in volatility expansion. Before many strong breakouts, volatility contracts noticeably. The market becomes coiled, like a spring under pressure. When the move finally begins, it often starts smoothly rather than explosively. The energy builds as participation increases. The impatient trader misses it because he was waiting for excitement. The patient trader recognizes the shift early. This is why emotional discipline matters so much in chart reading. If you crave action, you will naturally gravitate toward the loudest moves. And those are often the most crowded and dangerous. But if you train yourself to appreciate quiet structure, you begin to notice opportunities forming before the crowd arrives. The market rewards preparation far more often than reaction. You must also remember that boredom is often a feature, not a flaw. Markets spend more time building moves than executing them. The accumulation phase, the tightening range, the slow grind, these are the foundations of many powerful trends, but they rarely feel exciting in real time. And just before one of the cleanest breakouts begins, the chart often becomes so uneventful that most traders stop paying close attention. The way price leaves a level matters more than how it arrives. Most traders spend their energy watching the approach. Price moves towards support or resistance, and they lean forward in their chair, waiting for the moment of contact. They mark the level. They prepare the order. But the experienced operator knows the real information often appears after the level is touched. Tell me, how often have you focused on the test, but ignored the reaction? That reaction is where the truth lies. Price can arrive at a level for many reasons. Momentum can carry it there. News can push it there. Short-term traders can chase it there. The arrival itself tells you very little about strength or weakness, but the departure, now that reveals intent. Does price snap away with urgency? Does it stall and drift? Does it break through cleanly and hold? These behaviors are not random. They are evidence. When a market respects a level strongly, you will often see a sharp, confident reaction. Buyers or sellers step in with purpose. Candles close decisively away from the area. Follow-through appears quickly. The market does not linger because real orders were waiting there. Have you ever watched price touch a level and immediately move away so cleanly it almost looked rehearsed? That is meaningful behavior. On the other hand, weak reactions tend to look hesitant. Price pokes the level, bounces slightly, then drifts back again. The candles overlap. Momentum fades quickly. This kind of sloppy departure often signals that the level is not being defended with conviction. And when conviction is missing, the level becomes vulnerable. Many traders get trapped because they treat all touches of support or resistance as equal. But markets are far more nuanced than that. Two charts may both show price hitting resistance, yet the quality of the reaction can be completely different. One shows rejection with authority. The other shows uncertainty disguised as movement. Advanced chart reading is the art of spotting that difference. Another important clue lies in speed. Strong markets tend to leave levels quickly. Weak markets tend to hover. If price spends too much time leaning on a level, it is often a sign that pressure is building. Think of it like a door being pushed repeatedly. The longer the pressure persists, the greater the chance the door eventually opens. Have you noticed how the cleanest breakdowns often come after price keeps knocking on support again and again? Time at level is information. Volume can also help confirm the story. A sharp move away from a level on expanding participation usually deserves respect. But if price reacts weakly on thin volume, caution is wise. The market may be testing liquidity rather than committing to direction. You must train your eye to observe the sequence, not just the snapshot. One candle is rarely enough. Watch the next few bars. Does the move build on itself, or does it lose energy immediately? Does structure improve, or become messy? The disciplined trader waits for the market to reveal its hand. He does not assume strength just because price touched support. He does not assume weakness just because resistance was tested. He watches the exit, because that is where intention becomes visible. Over time, this shift in focus changes how you experience the chart. You stop reacting emotionally to every touch of a level. You become more patient, more selective, more skeptical of obvious setups. You begin to understand that the market often shows its true strength, not at the moment of contact, but in the moments immediately after. And occasionally, when price leaves a level in a very particular way, it is quietly signaling that something much larger may be about to unfold. Risk management turns chart reading into wealth building. A man can read charts beautifully and still go broke. I have seen it more times than I care to count. Sharp eyes, good instincts, perfectly timed entries, and yet the account bleeds slowly, almost politely. Why? Because knowing where to trade is only half the business. Knowing how much to risk is what keeps you in the game. Have you ever been right on direction, but still lost money on the trade? That is the lesson most traders learn late. The chart gives you opportunity, not protection. It shows you where the odds may lean, but it does not guarantee the outcome. Even the cleanest setup can fail. The professional accepts this before the trade is ever placed. The amateur hopes it will not happen this time. Hope is expensive. Proper risk management begins before the entry, not after the trade starts moving. You must decide, calmly and without emotion, how much of your capital is truly at risk if the market proves you wrong. Not what you wish to risk, what you are prepared to lose without damage to your long-term survival. Because survival, more than brilliance, is what builds trading wealth. Position size is where many capable chart readers quietly sabotage themselves. They see a strong setup and suddenly feel confident, too confident. Size creeps up. Stops widen. Discipline softens. But the market has a way of humbling oversized conviction. One poorly sized trade can undo the careful work of 10 good ones. Does that sound familiar? Consistency in risk is the professional's shield. When you risk a controlled, predefined amount on each trade, something important happens. Losses become manageable. Emotion stays contained. Your equity curve begins to smooth out instead of lurching wildly from one extreme to another. The goal is not to avoid losses. That is impossible. The goal is to make losses small enough that your edge has time to work. Advanced chart reading gives you better locations. Risk management gives you longevity. Stops must also be placed with logic, not fear. Too tight and normal market noise will shake you out. Too wide, and you are no longer managing risk. You are absorbing punishment. The chart itself usually provides the answer if you study structure carefully. Where would the trade idea clearly be invalidated? That is the only place a stop truly belongs. Many traders reverse this thinking. They place the stop first based on comfort, then try to justify the trade around it. But the market does not adjust to your comfort. Your risk must adjust to the market structure. There is also the matter of capital preservation. When drawdowns come, and they always do, the disciplined trader reduces exposure. He does not try to win it back quickly. Revenge trading is the fastest way to turn a temporary setback into lasting damage. Have you ever felt the urge to double size after a loss just to get back to even? That impulse has ruined more accounts than bad analysis ever did. Wealth in trading grows unevenly. There are quiet periods, steady periods, and occasional bursts when the market aligns beautifully with your method. Risk management ensures you are still present when those favorable periods arrive. Without it, even the best chart reader eventually runs out of capital. Or confidence. And confidence, once damaged by poor risk discipline, is not easily repaired. The traders who last the longest treat risk like a business expense. Controlled, measured, expected. They do not celebrate oversized wins or panic over routine losses. They focus on process, knowing that over a large enough sample, disciplined execution compounds quietly. Because in this business, the difference between a skilled analyst and a consistently profitable trader often comes down to one quiet habit. Most traps on the chart are designed for impatient traders. The market has a way of testing temperament before it rewards skill. You may think you are being fooled by bad luck or sudden volatility, but more often than not, the trap was visible long before the loss occurred. The trouble is not that the warning signs were hidden. The trouble is most traders were in too much of a hurry to notice them. Have you ever jumped into a trade quickly, only to realize moments later the move had already lost its strength? Impatience is expensive. The market understands human behavior better than most traders understand themselves. It knows the crowd chases breakouts, fears missing moves, and grows restless during quiet periods.